I think the industry has done a good job at creating, managing standard annuity products. I think there's still some room to improve around individual longevity, underwritten annuities, especially in understanding how selection impact the longevity risk when an annuity is underwritten. Overall, however, I think it's important to note that the insurance industry is still the sole provider of a complete, comprehensive protection solution for the financial risks associated with the longevity risk. I think we've done a good job at pricing and underwriting longevity much better over the past, let's say, 20 years. Now we account for the health of the, let's say, potential customer, lifestyle choices, occupation of the potential annuitant. However, the way we price longevity is mostly based on past experience. So we try to find trends and patterns in the past experience and extrapolate that to project in the future where we believe the longevity will be going. However, that approach, of course, as a blind spot, a weakness, is that it doesn't really take into account the new known advances that will have an impact on longevity going forward. This is why I think we need to combine that actuarial study of past trends and patterns in the mortality with a forward-looking analysis of the main drivers of longevity going forward. Yes, it is. I think for me, the longevity and mortality risks, and longevity with other lines of business as well, but especially with mortality is natural hedge, probably more around extreme events. So if we have an extreme mortality event, such as a pandemic, or an extreme longevity event, such as an immediate cure for all cancers, I think in these cases, the mortality and longevity are really good hedging approach that insurers and reinsurers can use, yes. I think as you pointed out, the investment banks, worked really hard for about, I would say, 10 years to try to bring solutions to the market. But I think the main reason that it did not work out for them is that they were not able to create a liquid secondary market for these securities. Therefore, I think you need a secondary liquid market for the potential buyers of these securities to be able to market these securities for the real value of the securities, and also to be able to sell in a reasonable time frame, in a predictable way, these securities. To complete my answer, I think we are likely to see partial, imperfect market-based solutions. What I mean by that is that probably limited in time into the hedging they are providing, or being index-based, therefore not a perfect hedging solution. But I think we're likely to see such solutions in the near future.